Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. When a six-fold surge in profits just isn't enough. SK Hynix slumps as the chip giant says capital spending will rise around 50% this year. The results dragging South Korea's Kospi lower, now on track for its worst month ever. Meanwhile, oil rebounds as the US says it intercepted an Iranian attack on its forces, adding to inflation fears ahead of today's decision from the Federal Reserve. And three of Europe's biggest banks report. Standard Chartered and UBS beat profit expectations, with Deutsche Bank's numbers just crossing the wires. We'll hear from executives at all three lenders. Well, a very good morning. Here is the picture in markets this Wednesday. It is, of course, Fed Day, but once again, we've got to start in South Korea. The Kospi down another 9% as things stand after an 11% plunge already yesterday. The catalyst this morning is SK Hynix missing its lofty profit estimates. The shares have been down some 10%, now about 16% on the Kospi. So trading on the benchmark index halted again this morning for 20 minutes earlier, and the broader Asian index battling gravity as well. Now the AI woes spreading worldwide. You can see Eurostoxx 50 futures down 0.5%. Nasdaq futures down 0.6%. The Nasdaq already having ended yesterday's session on the brink of a technical correction. But flip cross asset now, because there we find another layer of uncertainty for investors who are already rotating out of tech stocks. Oil surging this morning, up 3.9% on Brent at $87 a barrel. On that fresh fighting in the Middle East, raising tensions, that boosting Treasury yields. The 10-year now quite steady, actually, 461 on the 10-year. But I've also thrown in the Bloomberg Dollar Spot Index here because it is Fed Day. It isn't moving much yet, but this is worth keeping an eye on. TD warning that the dollar could fall some 0.3% if the Fed holds rates with two or fewer dissents later. So watch out for that hawkish momentum building. It is a busy day ahead of us, particularly for earnings. Let's get started. We begin with breaking earnings from Deutsche Bank. Of course, the big question is how much European banks can continue the strength that we already saw on Wall Street, and analysts forecasting higher fixed income trading and potentially a second tranche of its share buyback. So what you are seeing are beats for second quarter fixed sales and trading revenue. They're planning a new €500 million buyback in the second half. They are saying that pre-tax profit also beat, and they're confirming that they're on track for strong full-year operating performance. Deutsche saying that it is firmly on track for its 2026 revenue ambition. So we're going to be hearing from the Deutsche Bank CFO Raja Akram later on this hour on Daybreak Europe. Deutsche Bank's traders seeing a 16% revenue rise to beat Wall Street. So lots to talk about with Akram later on in the on Bloomberg TV. Now let's turn to the broader markets now, and we have Korea's Kospi halted again. Let's get an update from Asia from Winnie Su in Hong Kong. Winnie, tell us more.
Yeah, good morning, Lizzie. Well, you just mentioned that with the Kospi here down more than 8% earlier today, it did trigger a circuit breaker. And in fact, this is the first time on record we've seen a back-to-back circuit breaker from yesterday already. So momentum is really unwinding very quickly for the South Korean market. And here, in fact, the losses are being mainly dragged down by SK Hynix, which is down about 12% today. Now, a couple of different factors. Mainly, it is the earnings missing by 6% compared to analyst estimate. But on top of that, also the rise in Capex spending, as well as the lack of details when it comes to earnings call, where we didn't hear much when it comes to the shareholder returns and also the long-term contracts that the company is signing with some of its clients. So those are really creating those uneasiness when it comes to investor sentiment. Now, flip the board, I just want to show you to what extent really this market has been falling, because because, in fact, we did have a chart showing how the South Korean market has fallen by about 40% from its June peak, and it is taking its monthly losses to the biggest on record. Now, with the 40% drawdown so far this month, the July month has also made South Korea's Kospi index the worst performer compared to all of its other global peers. So you can see on this chart that really it is a very, very sharp turnaround when it comes to the story. Now, just going back to the chart when we also talk about the broader Asia market, because we are seeing MSCI Asia also extending those losses by more than 2%, which is coming after it already entered a technical correction territory just yesterday. And worth mentioning that we are also very closely watching out for the aftermath of that massive earthquake that hit Japan's Kumamoto prefecture yesterday. It is the prefecture and the area where we have lots of factories and lots of manufacturers. Some of the factories are in fact suspended right now, and we've also confirmed right now 13 people died from the earthquake. Now, with the big explosion at that Aeon Mall, we are seeing some gains when it comes to the construction stocks because of the expectation for further reconstruction around that region. Japanese yen here strengthening just a bit ahead of the Fed meeting and the Bank of Japan meeting expected to come this Friday. For now, we are expecting a hold. The only bright spot we're seeing today is in the textures in Hong Kong, strengthening by about 2%, coming as some rotation out of this AI trade and into the likes of EV shares, which are seeing some gains as expectation rise for the memory chip prices to ease further. Back to you, Lizzie.
Winnie, thank you very much. That's Bloomberg's Winnie Su out of Asia. Well, let's zoom in on SK Hynix, the heart of the Korea moves. Shares sharply lower, as Winnie says, after second quarter operating profit missed estimates, despite jumping more than 550%. Investors concerned the firm has earmarked at least $31 billion in capital spending this year. We could bring in our Bloomberg intelligence analyst, Masahiro Wakasugi. Masahiro, good morning to you. We know that SK Hynix shares are volatile, but just put these numbers into perspective for us. How should we interpret these results?
Right. Good morning. Yes, if we look at SK Hynix earnings, revenue was 5-6% below consensus, and the operating profit as well. And as you know, that Micron and Samsung reported a few weeks ago, and they delivered solid numbers. And probably SK Hynix issued ADR, so the market had a pretty high expectation. So, and if we look at the DRAM ASP increase and the NAND ASP increase, which was around 30% for DRAM and 55% for NAND in second quarter, and if we had 5, 6, 7 percentage point better ASP increase, SK Hynix might have achieved a consensus profit. So I think that probably the culprit could be the ASP in the second quarter. And the reason maybe we think that SK Hynix was mentioning that some kind of product delay was shift to the third quarter or fourth quarter. And if we look at the HBM revenue in the second quarter, which is included in the graphics segment, and the sales were not as strong as expected. So maybe the HBM revenue recognition could be the one of the reasons why we saw the a bit weaker result for SK Hynix.
Okay, really appreciate your insights. Bloomberg intelligence analyst Masahiro Wakasugi there. Thank you very much. Well, aside from the tech headwinds that are emanating out of South Korea, the other weight on stocks this morning is higher oil prices. Brent now up 3.6% to $87 a barrel after the US said that it had intercepted an attack on American military bases in the Middle East. US Central Command also said that US and Saudi forces had carried out strikes on Iran-backed militants in Iraq in response to attempted drone attacks on US forces. The attacks, of course, end days of relative calm. So let's get the latest now with Bloomberg's Abir Abu Omar, Horizons Middle East and Africa anchor, of course. Abir, good morning. Just bring us up to speed on the latest attacks and talks.
Good morning, Lizzie. So yeah, unprompted, it looks like this is an Iranian attack on some U.S. military bases in the region. Just moments ago, we were seeing that Jordan was reporting 5 missile strikes by Iran as well on its grounds. And so we're seeing another escalation in the Middle East, followed by, as you have mentioned, days of calm. The United States had stopped its attacks on Friday unprompted. We don't have an explanation from the United States or President Trump on why those attacks have stopped, but that led Iran to suspend its own attacks on the region, albeit for just a couple of days, because we saw those fresh strikes by the IRGC on the region. And so we await and see what the U.S. does when it awakes, whether President Trump will decide to launch yet another round of strikes on Iran. He did say before all of this that he was planning a massive strike on Iran, only to stop a few days ago. Reports, Lizzie, of course, about the lack of munition or the diminishing munition by the United States have come about with President Trump denying them. In the midst of all of this, of course, we're keeping an eye out on the Strait of Hormuz and those talks between Iran and Oman to establish a middle passageway, if you were, and that is a passageway that hasn't been used throughout the course of the war, because Iran has been asking ships to stick to routes that are close to its borders by the northern side of the Strait of Hormuz. So those talks are still ongoing. We don't have reason to believe they're going to be finalized soon, but those remain to be seen. And then on the other hand, Lizzie, we also have the Red Sea, which has been seeing movement by the Yemen Houthis against Saudi Arabia. Saudi and the U.S. also striking militias backed by Iran in the eastern part of Iraq. And we have reason to believe that those were the first acknowledged such attacks by Saudi Arabia against Iraq in decades. And so an escalation on all fronts. We're actually seeing new fronts emerge in this war, but it remains to be seen. It's again wait and see mode yet again in the Middle East.
Abir, thank you. That's Bloomberg's Abir Abu Omar, who'll be back with Horizons Middle East and Africa at 5 a.m. London time tomorrow. Now, let's take a look at the risk events on the agenda for today. At 9:30 a.m. London time, we are going to get UK mortgage approvals. We've also got a raft of earnings, Airbus, L'Oreal among those reporting. Then, perhaps the highlight, 7 p.m. London time, the Fed decision. Could we see a surprise hike out of Kevin Warsh's second meeting at the helm? A credibility hike, despite the respite that we had seen in the Middle East conflict. Then even more earnings, this time on the tech front. We'll be hearing from Microsoft, Meta and Qualcomm, set against the context of course, those huge worries about AI Capex that have surfaced in the SK Hynix story, hence yesterday's Nasdaq plunge. All of this very much in focus. But we have even more earnings to bring you. Still ahead on Daybreak Europe, we'll be speaking to the Standard Chartered CEO, Bill Winters, for an exclusive conversation to discuss his bank's results. That at 6:30 a.m. London time. First, though, we're going to count down to the Fed decision, with investors split on the central bank's path ahead. So that's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:15 a.m. here in London. Well, the Fed is expected to hold rates steady later today, but traders are eyeing a near 1 in 3 chance of a surprise move higher as the central bank grapples with inflation pressures. With the preview, let's bring in Ven Ram, cross-asset strategist at Bloomberg MLive. And Ven, you've been telling us all week that a hike would be smart for Fed credibility. That should be a thing. That should be a word, shouldn't it? Fedibility. Decision day's here, though, now. Do you think that Kevin Warsh and his team are going to go for it?
Well, I think that the chances of his team going for it are not so minimal, because I think not least because if you look at the dot plot for June and what members penciled in, fully 8 members thought that the Fed rate should be higher than what it is now. So I wouldn't be surprised in the least if Kevin Warsh, and we didn't get Kevin Warsh's dot plot last month, as everyone knows by now, but so I wouldn't be surprised at all if Kevin Warsh voted for a hike and everyone else who's already inclined to take rates higher also votes with him. Now, having said that, I think that, if you look at inflation swaps, Lizzie, they are not telegraphing too much concern or too much angst about inflation in the US specifically, because US is a net energy inflation exporter. Let's keep that in mind. But I think that even so, there is something to be said for early action against inflation, because the inflationary pressures are broad-based, not just oil. And I think that there is something to be said for stamping out early inflation, because if you look at the 2021-2022 cycle, the Fed was behind the curve, and then they had to raise rates by as much as 75 basis points in a couple of meetings before bringing inflation to somewhat under control. I don't think that the Fed wants a repeat of that, and not least of whom is Kevin Walsh, because he's been repeatedly hawkish. So I wouldn't be surprised if he decides to take the first step today.
So how sharp a knee-jerk reaction could we see to this decision, Ben? I mean, across assets, we've already left the Nasdaq on the brink of a technical correction yesterday. How much pressure would a surprise hike add to US equities?
It would make US equities look particularly vulnerable, because this is not largely priced in. As you said, the markets see a 1 in 3, with about a 30% chance of a rate hike today. So meaning the bulk of the market is not prepared for the Fed to raise rates. And if they come out and indeed raise rates, that will rattle the markets, definitely the bond markets, and send yields higher. And that will have a knee-jerk impact on equities, which will sell off about 2 to 3% on the day, regardless of what happens beyond that. But I think on the day, you will see a 2 to 3% sell-off in US equities, simply because the discount rate that you apply to earnings valuations will be higher. The discount rate will be higher, which means that the prospective earnings yield will be lower. And therefore, I think that stocks will feel the knee-jerk and will sell off.
Mm-hmm. All right, well, I said it yesterday, I'll say it again, Ben. Strap in for a bumpy ride today. Ben Ram there, cross-asset strategist at Bloomberg Live. Coming up, though, we'll turn back to earnings and Rio Tinto raising its dividend as first-half profit soars. We'll bring you our exclusive conversation with the Rio CEO next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, we will be watching Rio Tinto at the open. It's already jumped in Australia after posting a jump in first-half profit off the back of strong commodity prices. Now, the miner says it'll double down on efforts to cut costs and build cash by boosting productivity and selling non-core assets. And the CEO, Simon Trott, has been speaking to Bloomberg.
Iron ore remains a really strong market for us. We've been talking for years about the maturation of China growth, and you're certainly seeing that come through. It's been far more resilient than I think market pundits had expected because of that underlying demand. And whilst construction in China has slowed, you've seen a real pickup in export-related steel demand, so secondary and tertiary products. And that's led to fairly robust and stable pricing outcomes in the market. We continue to engage with all market participants, including CMRG. And so, we through the ordinary course of business, we renew those contracts, and that's the phase we're in at the moment.
You've talked about that market evolving, though, and obviously at the moment that the economy is in a K-shaped recovery, and the property sector, fixed asset investment, probably isn't going to come back unless they return to the old economic playbook. Do you see the plateauing going downwards? What sort of a sharper slowdown might you be envisioning?
We've certainly seen over a period of years that construction segment slowing down, and it makes up a relatively smaller portion of our book now compared to 5-10 years ago, whereas really one of the big drivers. And as I say, you've seen that demand being replaced by export related, not necessarily steel exports of themselves, but related to the increase in manufacturing within China. And those products flowing to the rest of the world. I think domestic suppliers and scrap have probably been a bit less in terms of on the supply side than predictions, and so that's led to stronger pricing outcomes and pretty good cost support is probably the last point I'd make. Increases in raw materials, particularly energy, has meant that it's pretty well supported prices on the right-hand side of the cost curve.
Obviously, more strategically important going forward is the role of copper, right? And prices demand has held up pretty well this year. Beyond Oyu Tolgoi, where do we look next in terms of guaranteeing future demand?
So one of the things we outlined today is around 70% of the raw material cost of a data centre comes from the materials that we produce. So, aluminium, copper, lithium, as well as steel. And if you look forward, I mean, the spend next year on from hyperscalers, $1 trillion, and you convert that across, that's a lot of lithium, aluminium and copper. And so really excited about how we're positioned for the future. Fortunately, we've got Oyu Tolgoi, which is ramping up to the 500,000 tonnes of capacity. That ramp up's proceeding according to plan, and really pleased with the way that asset continues to perform. Kennecott in the US, one of only two copper smelters, and then a big pipeline of growth beyond that.
The Rio Tinto CEO Simon Trott there. Now to some other top stories we're following for you this morning. More earnings. Gucci sales fell less than expected in the second quarter as Kering looks to revive its largest brand. Comparable sales declined 2% against forecasts for a 3.3% drop, with improvement across all regions led by North America. Those results sent Kering shares sharply higher in the US session, so we shall continue to watch them in the European session. Elsewhere, ASM International has forecast third quarter revenue above analyst estimates, saying demand for its chip-making equipment is being driven by the global build-out of artificial intelligence infrastructure. And the CEO of ASM International will also be joining the opening trade just after 7 a.m. London time. Meanwhile, EssilorLuxottica says that revenue from its smart glasses nearly doubled in the second quarter, though overall revenue for the period missed expectations. The Ray-Ban owner has partnered with Meta to make smart glasses, but says growing competition has seen its shares fall nearly 40% this year. Its earnings eased some investor concerns, with operating margin beating expectations. Well, coming up on Daybreak Europe, new share buybacks from Deutsche Bank and Standard Chartered. As Europe's banks report, we'll bring you interviews with the Deutsche CFO and the Standard Chartered CEO. That's next. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. When a six-fold surge in profits just isn't enough. SK Hynix slumps as the chip giant says capital spending will rise around 50% this year. The results dragging South Korea's Kospi lower, now on track for its worst month ever. Meanwhile, oil rebounds as the US says it intercepted an Iranian attack on its forces, adding to inflation fears ahead of today's Federal Reserve decision. And three of Europe's biggest banks report. Standard Chartered, UBS and Deutsche Bank all beating profit expectations. We'll hear from executives at all three lenders. Well, a very good morning. If you are just joining us, 6:28 a.m. here in London. This is the picture in markets this morning. We have to start with the Kospi yet again, currently down 6.7%. We've seen the index closed for trading, halted again for 20 minutes after an 8% decline earlier on in the session. It comes back to SK Hynix. We've seen double-digit losses on the shares this morning after it missed its lofty profit expectations, and we have futures pointing lower on both sides of the Atlantic as well. Flip cross asset, and you can find another reason there. Oil surging on Brent. We are at $87 a barrel because of the latest Middle East tensions. That boosting Treasury yield, and we're keeping an eye on the dollar, of course, in case of a potential surprise from the Federal Reserve. Is it going to hold rates with two or fewer dissents later? TD warning the dollar could fall some 0.3% if that is the case. Now, let's turn back to earnings. Deutsche Bank announcing a new €500 million share buyback programme. Let's hear from its CFO.
Not only is it a record second quarter, but it's also a record first half for us. But what's extremely pleasing is you mentioned the significant beat on investment banking, but actually we had record flows from asset management, almost 9% growth from our private bank. Corporate bank is continuing to show signs of progress, which we assumed. continuing to invest across the franchise. Capital position strong. We announced another buyback today. So I think all in all, I would say in this political and geopolitical environment, I think these are stellar results.
And I want to get into some of the different sort of sections there, but thinking about kind of now going into the third quarter, have you seen those trends remain kind of intact, particularly on the trading side? Is this something that we're going to see again in the third quarter?
Yeah, again, July started pretty constructively on the trading side. It's kind of continued the momentum from June. So as I look at both on the market side and on the investment banking side, I think the pipelines look pretty full. So it gives me a lot of optimism that the second half of the year could potentially be as strong as the first half.
And also thinking about this share buyback that you've announced now, 500 million euros, which is in line with a lot of what the analysts were looking for. What is also notable about it is it's the first time you do it from the in-year net profit, right? What does that tell us about kind of the potential looking forward in terms of the buyback policy over at Deutsche Bank? Does that give you more kind of leeway to do actually more in the coming years?
Yeah, look, the buyback is exactly in line with the communication we did at the Investor Day that we would like to shift to an in-year buyback. And I think from my perspective, it exhibits two things. One is the earnings power of the company. And two, the confidence that we have that we can actually execute these buybacks as we generate those earnings because we have a good look towards the future. So it's actually going from 50% of our net income to 60% and doing it earlier. So I think from my perspective, it's great for the shareholder because they get more and they get it earlier. And as we said in our Investor Day, once our ratio is sustainably about 14%, we will do excess share buybacks, consider excess share buybacks. So, and the cadence that we have just means that once we get to that point, investors can expect to get that earlier than they normally would.
Looking into the back half of this year, the beginning of next year, we're expecting some very large IPOs, Anthropic, potentially OpenAI as well. Are those deals that you could potentially be a part of? What does the pipeline look like?
So just looking backwards, we were involved in 3 of the largest deals in the first half of the year as probably one of the only European banks that actually participated. Without going into specific names, I think we are set pretty well to participate in future deal activity. And remember, the deal activity in U.S. has been exceptionally strong in the first 6 months. Europe has been kind of muted. As Europe picks up, we're actually going to be an outsized beneficiary of that trajectory.
And so what is your expectation in terms of deals in Europe? Because, we've talked about the revival of the market for quite some time. Yeah. Is that something that you see as imminent?
We saw a little bit sideways in the first half. It clearly didn't see the same level of wallet share growth that we saw in the U.S., but thankfully we are present in the U.S. We have competitive skills there. I think Europe seems to be picking up. Now, whether it will be of the same magnitude that we saw in the U.S., that remains to be seen. But as I look at the second half pipeline, it's across U.S. and Europe. And
so you're painting a very sort of positive picture. How does that bear on your revenue targets? You say that you can, obviously the goal is for 33 billion euros this year. Is that something that you are likely to beat given just the conditions that you're describing?
So look, first half is usually traditionally always stronger. And the second half quarter also has been great. I would say, while we're not updating the number was approximately 33 billion. As I sit here today, I think we will be comfortably getting to that number. And if things go well, potentially a little bit better.
A very upbeat Deutsche Bank CFO Raja Akram there speaking to Bloomberg's Chief Europe correspondent Oliver Crook. Well, staying with bank earnings, Standard Chartered has announced a $1 billion share buyback as it reported second quarter earnings that also beat expectations. The London-based lender posted a pre-tax profit of $2.33 billion for the 3 months through June, exceeding a Bloomberg compiled estimate of $2.08 billion. I'm pleased to say the Standard Chartered CEO, Bill Winters, joins me now. Bill, really great to have you back. A record first half. You must be smiling as well. But we've seen beats for Deutsche there. We've seen for UBS as well and on Wall Street. The bar is high. What's your message to shareholders mid-year?
Look, we're obviously very happy with the first half earnings, the second quarter earnings. The environment is good, as you just noted. Other banks are also having a good run. I guess what we'll be looking at is how sustainable is this good run? We feel very, very good about the momentum that we've got. The second quarter for us was everything from our wealth business to our banking business to the day-to-day activity in our financial markets business is growing at double-digit or stronger rates. So that we think bodes very well for the future, which may be a continuation of this trend for some time. The underlying support pillars are really quite strong. If there's some sort of a correction or an adjustment to the economy or something like that, I think we've also demonstrated that we're extremely resilient. So we have no observable credit losses. We've been quite cautious in terms of taking some precautionary provisions, but really very small in the overall scheme of things. And no underlying credit problems. So the combination of like good downside protection and very strong upside momentum, we think puts us in a good place.
So you've announced this $1 billion buyback. What does that say about the international banking industry at this point, that you're using the capital to repurchase your own stock rather than building a war chest for acquisition?
Well, thankfully, we've got a very strong capital position. So our CET1 ratio, the ratio that is the indication of our aggregate capital, is 14.2%, which is extremely strong. So even after the buyback, we'll still be in the top half of the range that we indicate. So we've got a very strong capital position, super strong balance sheet, as evidenced by the fact that we just don't have material loan impairments, and an extremely liquid balance sheet, as we typically do, but we're at the top end of our range. So for all those reasons, we're protected against whatever pullback or surprise may come, but we are investing fully in the business. So, $1 billion buyback, but we're investing well over $2 billion of cash into our business year after year after year and growing. So first and foremost, we invest in growth.
Yeah.
We take the surplus and return it to shareholders.
Well, OK, with all that good news in mind, you've got shares trading at or close to all-time highs. How much further could the stock rise from here? The current target is about £22, I think. We're trading at about £21.30. Is 25 or even 30 a possibility during your tenure as CEO?
Yeah, I've been instructed never to predict a stock price. But I'll make a few observations. One is at something like 9.5 times earnings. For a stock that's generating earnings per share growth in the high double digits, so 18, 19, 20% compound growth, those two things don't sync. Right? I mean, we're a growth stock, and we've demonstrated that for about 5 years now. The underlying drivers of growth are very good. We've got an ongoing transformation program, which is making us more and more efficient every year. And we're doing that with a very focused effort on reskilling our employees for the future. And those things say to me, as a growth company in growth markets, we should probably be trading at a higher price earnings multiple. Okay. But that's for the market to decide. OK,
well, I'm sure they'll have a read on your company later on this morning. Look, Bill, I haven't had a chance to ask you personally about your comments on AI. You know what they are. They were widely reported. On AI replacing lower value human capital. You've apologised for them. Since then, though, have you had more thoughts about how your bank and other companies should be introducing AI to your businesses?
Yeah. Well, first of all, thanks for raising that. But let's start by being clear what I said. What I said was that it's critical for a corporation, it's essential, and it's a strategy for us to invest in our colleagues well ahead of the automation or AI. This has been going on for years, and we've been automating processes from the beginning of time, well before the role is eliminated, because roles have been and will continue to be eliminated by automation, to invest in the skills in our colleagues that allow them to be productive members of our community in the new world.
But you've humanized the language. Have you humanized the approach?
Well, I think it was extremely human before. So what I said was, if we don't make that investment in our colleagues, which we do, it's a corporate responsibility. If we don't, then we'll have roles being eliminated in favor of the machines. Right? My comment was exactly the opposite. We value our employees extremely highly, which is why we make those investments in the first place. Of course, it got reported the other way around because it's a good headline, but that's life.
OK. Well, on AI, what's your view about Chinese versus US AI models? Is good enough and a bit cheaper good enough for you?
I'm sure that there will be convergence over time. So obviously, in particular, the frontier labs in the U.S. have invested very heavily to train their models in the first instance. We're finding that the Chinese are investing very heavily to deliver lower cost of inference, so the actual application of these trained models. The U.S. will also, the frontier labs and the hyperscalers and others who are very active in the space will converge onto some common technologies over time. But we know that net, in order for the existing investment to generate a return, there's going to be pressure on prices, which just doubles down the need for us to continue to be investing in our transformation and productivity to absorb those increases.
But then do you see more of your future token spend going to Chinese providers than at the moment?
So we use a range of models today. In China, we're using almost exclusively Chinese models. Obviously, we have a big Chinese business. In the West, we're using almost exclusively, I think we can say exclusively, Western models, which means U.S. for the most part. And they are, for many tasks, they're similarly capable. For some cutting-edge tasks, you'll want to have one model versus another. And I think what will happen through time is that the aggregators, and whether that's companies like Microsoft or Google or users like us, will find a way to plug in different models for different uses.
How concerned has the bank been about changes in Chinese policy on cross-border financial flows? Could that impact the growth of your wealth business?
So we're very happy with the progress of the wealth business in the second quarter, which was the time during which all the speculation arose. So we've seen no discernible change in our flow of activity through the quarter. What we take from the various pronouncements, and there have been a few, I think, probably unrelated things, but maybe they have something in common, which is that the Chinese saying we are internationalizing our currency. The RMB is internationalizing. Capital markets are opening up. It's been happening for 25 years. Kind of slowly and steadily. But they've been reinforcing the fact that that's the direction of travel. But what they've said is we have a set of rules, and we expect everybody to follow those rules as we open up. So they sanctioned some offshore securities companies earlier in the quarter, and that sent a bit of a ripple to the market. Maybe they're changing the underlying intention. We see no sign that the underlying intention is changing. But we do see a crackdown on compliance. And, of course, we've seen a crackdown on tax compliance as well. This is very normal, I think. We see that in the U.S. and Europe and Japan, Korea all the time. This is just Chinese doing it their way.
Just finally, let's talk about the macro backdrop. How worried are you about the movements that we're seeing in energy prices? Oil's higher again today. Do you think that the main risks around the Iran war are priced in already?
Very hard to say. So obviously it's been a volatile environment from day to day. At this sort of energy price, in the $85 to $90 per oil range, the economy has demonstrated pretty extraordinary resilience. Obviously, for an extended period of time, we begin to worry about some of the actual supply chain shocks. Are the feedstocks for petrochemicals actually making it out of the Gulf or being replaced elsewhere? And certainly some corporations, some emerging markets, some sovereigns, will begin to be tested if we have a very long period of these elevated energy prices. But so far, the resilience has been extraordinary.
Bill, always great to have you in with us. Standard Chartered CEO Bill Winters there. Thank you very much for your time.
Thank you.
Well, staying with the bank earnings, UBS has also posted second quarter net income that beat estimates and announced a new share buyback programme. Theirs worth $3 billion. The Swiss lender benefited from a surge in trading activity and bought in new assets from wealth management clients than expected. But UBS was cautious on the outlook for the upcoming quarter, given the ongoing geopolitical uncertainty and volatile energy prices. We'll be hearing from the UBS CEO as well. That's Sergio Ermotti, of course. He'll be on the opening trade at 7 a.m. London time. Well, coming up on Daybreak Europe, big questions over massive AI spending. Will Meta and Microsoft have the answers when they report later? We'll bring you a preview of those reports next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:45 a.m. here in London. Well, we're hoping to get a good read of the global tech picture later when even more of the Mag 7 report their latest results. We'll get Microsoft, that's expected to produce strong sales growth, while investors wait for news on Meta's efforts to build a cloud business. That could open new revenue streams as well. Let's bring in Bloomberg senior strategist Neil Campling for a preview now. Neil, what are you expecting from these two? Is it going to be actually more of this less is more narrative when it comes to Capex in terms of the investor reaction?
Yeah, I mean, we had the kind of warning signs, if you like, from Alphabet last week in terms of that, the spend to build out these AI ecosystems is substantial in terms of the Capex required. So you have to offset that spending with high sales growth. So you need to look for the top line growth numbers for both companies, and then what we're going to see in terms of free cash flow, and then also the Capex spend as well. Microsoft, in terms of the partnership with OpenAI, that'll be a question on the call. The spending will clearly be, will they be matching Alphabet and trying to build out the system? Whereas Meta need to spend to kind of look for these new revenue streams, as you mentioned. But at the same time, this company has delivered almost $50 billion of free cash flow over the last 12 months. And forecasts are that this could turn negative going forward. So that's a big question in terms of that risk and how investors look to offset the concerns around that free cash flow relative to growth.
OK, so that's on the earnings front. I also want to ask you about this political intervention from Mark Zuckerberg this morning. We were actually just talking about US versus Chinese AI with Bill Winters from Standard Chartered. But Zuckerberg basically speaking out against the US restrictions on Chinese AI models. What do you make of it?
I think that's because probably for Meta, if you look at their positioning, they just want the access to the cheapest possible AI in terms of token costs being lower, so they can build out their own ecosystem with the best tool set that there is, so they can try and make better returns on their investment. But that does, as you mentioned, create some of the tensions here between these frontier models in different places. And we've seen a lot of concerns as to allowing access to some of the US models through bad actors coming from other countries. So there is that issue, as well as IP around, the technology IP. There's basically been a battle between China and the US. And so I don't think Washington are anytime soon going to allow broad access to the Chinese models because of that concern, I'd say.
OK, really interesting, Neil. Thank you so much. That's Bloomberg's senior strategist, Neil Campling, who it's fair to say has a busy 24 hours ahead of him. Now, to some other top stories that we're following for you this morning. Bloomberg understands that European football governing body UEFA is considering a boycott of FIFA events. It comes after FIFA unveiled proposals that would see it seek private investment for the first time, looking to raise as much as $4.2 billion. UEFA said the plan crosses a line, and internal talks are said to have taken place about clubs and national associations not attending events, including the World Cup and Club World Cup. Elsewhere, Ukrainian President Volodymyr Zelensky says he discussed Patriot air defences and diplomatic efforts to end Russia's war during his White House meeting with President Trump. Zelensky described the talks as productive as Kyiv looks for ways to deter intensifying Russian missile and drone attacks. And it was a busy day for Donald Trump because the president also welcomed Israeli Prime Minister Benjamin Netanyahu to the White House, with the war straining ties between two normally staunch allies. Netanyahu was in Washington for the funeral, of course, of Senator Lindsey Graham, a long-time Iran hawk. Now coming to Europe, authorities in France and Spain are racing to contain wildfires threatening Bordeaux and Madrid before temperatures rise again. Hundreds of firefighters in France are still trying to bring a blaze in Gironde under control, while the advance of a major fire in Spain has been contained overnight. The president of the Madrid region says the situation is improving little by little. Well, we have plenty more coming up for you on Daybreak Europe. We'll look ahead to the Fed decision later on today. Stay with us. This is Bloomberg.